Good morning, everyone. My name is C. Anjali Agarwal, and I'll be taking your foreign exchange management, exposure, and risk management. So let's start with the topic today. I'll share my screen and you will see. So today our learning objectives would be some basic concepts about foreign exchange management and how we determine the exchange risk and exchange rate determination. Team, when we are talking about foreign exchange, the first thing that comes to mind is what is foreign exchange? Why do we need foreign exchange? And what are the various ways in which this foreign exchange is determined? You must be aware that with globalization, a lot of companies are also allowed to invest in India. And therefore, we need to know what should be the foreign exchange rate of different currencies against our own home currency. So what is an exchange rate? An exchange rate is simply what is the price of a nation's currency in terms of another currency, which is often termed as reference currency. Now, if I ask you one simple question, what is the rate of dollar? If I say it is 2, will you say, is it okay? Is it 2? All of you can type in the chat window, okay? You can type in the chat window whatever your answers are. So if I say the dollar is 2, or if I say the dollar is 0.9, or if I say the dollar is 85, 88, what is the correct answer? The correct answer here would be all three, depending upon which reference currency we have used. So if we use the dollar against the Indian rupee, then Indian rupee becomes the reference currency, and 88 or 88.5, whatever the rate is prevalent today, that is the exchange rate for dollar, $1 against the home currency of Indian rupee. Similarly, if I say that the dollar is 0.8 or 0.9, I might be using a different reference currency. I might be using a Great British Pound. I could be using the Euro, so which are more in price than compared to US dollar. Therefore, the reference currency is now Euro or Great British Pound. So then the price of the dollar is less than 1. So that means it is important to understand not just what is the exchange rate, but you also have to understand you are calculating the price of one currency against which another currency, and that another currency can be the reference rate. So for example, if you express the rupee dollar exchange rate in number of rupees which $1 will be able to buy, let's say if it is 88.5. So you can say that the exchange rate would be rupee 88.5 per dollar, and the rupee here becomes the reference currency. Similarly, if you talk about the dollar rupee exchange rate, that would be 1 upon 88.5. And in that case, it comes out to be $0.113. So if you are using 1 rupee, you will be getting 0.0113 approximately dollars. So dollar becomes the reference currency here. Now, this is, I hope you have understood what is the reference currency and how we calculate the exchange rate between two different currencies.
Sorry to disturb you, ma'am.
Yes.
You just on a slide you write something like student will understand in that manner more, like just by writing. Okay, slide is there. If
Sure.
you write it all, then just the student can and be slow, little bit slow.
Okay.
Okay.
Right.
Just writing. Please start writing. Okay.
Right.
So that okay.
So team, for example, the rupee dollar exchange rate is the number of rupees that $1 will buy, which is 88.5. So I can take the rupee 88.5 and it's against 1 USD. So here you will see the rupee is the reference currency. Similarly, if I have used pound against USD, the price could be 0.90, let's say. Here, the GBP or the Great British Pound is the reference currency. Right, team? Have you understood the concept of reference currency now? So $1 could be 88, $1 could be 0.9, $1 could be 2, $1 could be 1.8. It depends upon what the reference currency is. Here, if you compare the price of 1 USD against rupee, it is 88.5 at present, which is the current price almost. So the rupee is the reference currency in this quote. The same question, if I say, what is the price of 1 USD, 1 rupee against rupee? So it will come out to be 1 divided by 88.5 and it comes out to be $0.0113 per rupee, which means now for the rupee, USD is the reference currency. Right, team? If you have any doubts, please type in the chat window. I'll see from there and I'll take up the doubts. Else we can move forward if you have understood what is reference currency. Right? No questions, team?
Madam, student will ask if they have any query because they are allowed to speak on the as well.
Okay.
Okay.
Now, as we have seen, the exchange rate can be for spot or forward delivery, both. What do we understand by the spot or forward delivery? So, spot rate is the rate which is paid for delivery between 2 business days after the date of transaction. What do we mean by that? Spot rate. The spot rate is how many rupee you will get for USD or $1. So rupee can also be said as INR. You can also say INR USD. Spot rate is the current exchange rate. So if the current exchange rate is 88.5, then this is spot rate. If you do a transaction today, within 2 business days, it will get settled. So it takes 2 days to clear or settle the transaction. Okay. If the rate is quoted for delivery of foreign currency at some future date, that means you are not going to deal today, you are going to deal in some future date, it is called the future rate. So for example, if the rupee dollar exchange rate is 88.90 after 3 months, this implies that the foreign currency at some future date would be traded at 89.90. So it is after 3 months. Now, when we talk about the forward rate, it is important to understand that firstly, the time is confirmed. It has to be after some specified date. So if it is 3 months, it will be after 3 months. If it is 2 months, 60 days, 90 days, 180 days. So that period is specified for the future date. If it is 3 months, it will be the price after 3 months. If it is 60 days, it will be the price after 2 months. If it is 180 days, the future is for the forward price is for the 6 months. So here we can see it will be specified which currency, which will be the exchange currencies, and at which price the amount will be available after a certain specified. So a forward market contract here occurs when buyers or sellers or the customers agree to deliver the currency, one currency at some future date against some another currency. So they agree to transact a specific amount also. Let's say this rate is quoted for $1,000 or this rate is quoted for $10,000. So this is at a specified future date, right? Give me one moment, sir, please. It's becoming permanent. So team, I hope you have understood what is the spot rate and the forward rate. Now the forward exchange rate is set and agreed by the parties and it will remain fixed for the period for which the amount has been determined for the contract, regardless of any fluctuations in the spot exchange rate in future. What does this mean? So supposing the USD price was agreed at 88.90 after 3 months. So it will remain 88.90 even if in the spot market the price of dollar becomes 95 or 80. So whatever the fluctuations in the spot exchange rate is in future, that will not influence the forward exchange rate, which is set after 3 months for 88.90. So let us look at this example once again. 1 USD is currently trading at 88.50. This becomes the spot rate. However, after 6 months, let's say another time period, if the forward rate is determined for 1 USD to be rupees 89.30, this will remain 89.30. It means after 6 months, if 1 USD is bought, someone wants to buy 1 USD, how much rupee it has to give? It has to give rupee 89.30. Irrespective of whether the price of the dollar at that time is 95, 70, 65, 100, it will not impact the forward agreement or the forward exchange rate which was determined between the two parties. Those who have contracted to deal with the dollar after 6 months at 89.30, it will remain 89.30, irrespective of the price. So here we can see that the foreign exchange, so far we have calculated, number one, that exchange rate is the price of two currencies against each other. Number two, we have also discussed what is reference rate. So reference rate means the price of the currency, $1 or 1 unit of a currency against some other currency. So that other currency is called the reference currency. And third, we have now spoken about spot and forward rate. Spot is the current rate at which you can trade the currency, though you will get it not immediately, but after 2 days of the contract. And forward rate is the price at which the currency will be made available to you at some future point of time. And the specific amount of currency has to be taken into consideration. So the deal from the very beginning will be, let's say I want to buy 10,000 US dollar. I want to buy 5,000 US dollar. Or maybe I want to sell 10,000 US dollar or 10,000 US, 5,000 US dollar. Is it clear? So the amount, timing would be specified, amount would be specified, and the two currencies would also be specified. So you're going to deal either buy or sell which currency at this forward rate after 6 months. Further, there are two ways in which you can call a term, American term and European term. So when I say the quotes in American term, these are the rates which are quoted in amount of how many US dollar. When we say how many US dollar per unit of another currency. Now, if you are an American, right, for you, US dollar will become your home currency. Home currency is what? The one which we are locally dealing in. So for an American, home currency is US dollar. So either you can write the terminology as the nomenclature as USD, or you can use the symbol. For an Indian, home currency is the INR, Indian rupee, or you can use the symbol INR for the INR. Similarly, for anyone who is from Britain, he will be using the Great Britain pound, or the symbol for that is. So this becomes the home currency for the person who is living in the native currency. Now, what is an American quote? an American quote is how many USD per unit of foreign currency, right? So if I write, is it an American quote? You can type your answers in the chat window. Is it an American quote? Does it say 1 USD for how many rupees? Which one is the reference currency? Reference currency is rupee here. So this is not an American quote. What is a American quote? Where 1 US dollar per unit of foreign currency. Had I written it inversely, how many USD? Then it would have become 0.0113. How do you calculate that? 1 divided by 88.5. This becomes a American quote. Okay, this becomes an American quote, 0.0113. That means how many US dollar per unit of foreign currency. So any quote which is fluctuating with dollars are fluctuating and the other currency is kept constant at 1. How many USD for Great Britain pound? Let's say. This becomes a which quote? American quote. What is European quote? All other quotes are European quotes. When the rate is quoted in amounts of foreign currency per dollar, these are called European quotes. So this is a European quote. How many rupees per 1 unit of dollar? We will also talk about one more way in which the exchange rate quotes are expressed, which is direct and indirect quote. A direct quote is the home currency price for 1 unit of foreign currency. Think about it. You go to the market and you ask what is the price of apples to someone. What does the dealer tell you? Does he say that if you give me 1 rupee, I'm going to give you 0.05 kgs of apples? If you want to go and buy oranges, does someone say that if you give me 1 rupee, I can give you 0.25 dozens of oranges? Anything like that. Will you be comfortable to trade in the Indian market like that? No. If the apple vendor quotes us that you have to pay 100 rupee if you want to buy 1 kg of apples, we understand it very well. If the orange vendor says that if you pay me 80 rupees, I'm going to give you 1 dozen of oranges, that's a proper quote for us to understand. So we being Indian, we are okay if the rupee fluctuates and the other things, 1 unit of the other thing remains constant. In the exactly same manner, if you are given a quote that if you want to buy $1, you have to give 88. If you want to buy €1, you have to give 104 rupees. If you want to buy $1, 88.5 rupees. If you want to buy 1 British pound, you have to give 95 rupees. If you want to buy 1 Singapore dollar, you have to give 40 rupees. Similarly, this makes us easy to understand how much have we to pay in order to get 1 unit of foreign currency. So it becomes a direct quote for us as Indians. So a direct quote is the home currency price for 1 unit of foreign currency. For Americans, they are okay if they have to say that we have to pay 0.113 rupee per dollar. If they say that we have to pay per rupee. If they say that we have to buy, so let's say for a Indian, rupee by dollar is, let's say, rupee by Swiss franc. All these are direct quote for us. These are direct quote. So we have kept the foreign currency as 1 unit. $1 will cost how many rupees? 1 pound will cost how many rupees? 1 euro will cost 1 Swiss franc will cost you how many rupees? All this is direct quote for us. Indirect quote. You can simply reverse the quote, 1 divided by 88.5, and you get how many dollars? You can all use your calculators. So this is $0.113 per rupee. If you divide 1 by 95, maybe you get somewhere around 0.0110. These many pounds per 1 rupee. If you get 1 divided by 100, 0.01 euro per rupee. So you will see intuitively also that we are comfortable with these rates. So we as Indians are okay if we get a direct quote of how much we have to pay for $1, for 1 pound, for 1 euro, for 1 Swiss franc, or for that matter, any other currency. But if you are asked that if you want to buy dollars, you have to pay $0.0013 for every rupee. You have to pay this much for every rupee. This doesn't make us more comfortable. So this becomes an indirect quote for us. But very logically, this indirect quote for an Indian becomes a direct quote for an American. This indirect quote for an Indian becomes a direct quote for a Britisher. This indirect quote for an Indian becomes direct quote for any European nation. Is it making sense? So this is how you have to make the calculations. Now, we also talked in the previous slide about American and European quote. So any quotation which is a direct quote for American is American. Is also called as is a American quote. We can relate the two concepts here. Any quote which is a direct quote for a American becomes the American quote. So once again, quick recap, a direct quote means how much home currency you have to pay or you will get for 1 unit of foreign currency. An indirect quote, on the other hand, means how many units of your currency will you pay, how many units of foreign currency will you get for 1 unit of your home goods? So whether you buy or you sell. This is the exchange rate quotation for direct and indirect both. What is PIPS? PIPS is the price interest point. So we'll look at one very interesting concept here. Now, if I say the rupee dollar price is 88.50. What is the minimum rate this can change? This will change. Here, the PIP is 0.01. So that means price interest point. This means that if you get a fluctuation of exchange rate between rupee and dollar, what you will get is either 88.49 if the price of dollar decreases, or you get 88.51. So this is the minimum fluctuation you will have in dollars, upward or downward, if there is a difference or a change in the exchange rate. The same rupee by dollar, if I had mentioned as, let's say, 88.5025. Now you can see that I have expressed the price of the dollar up to 4 decimal points. So the PIP becomes here 0.0001, 4 decimals. Now if I say what is the minimum fluctuation that dollar can have, it's 88.5026 if it goes up, or 88.5024. So it is far less than 88.49 or 51. Right? So this is the meaning of PIP. It is the price interest point. It is the smallest unit by which one currency quotation can change. So if the USD INR, that is 1 USD equal to how many INR quoted to a customer is INR 88.50, the minimum value this can change is either 88.49, 88.50. That is when the PIP was 0.01. What if the PIP was 0.0001? That means we are taking the decimals up to 4 decimals. The price of a currency up to 4 decimals. In that case, the higher price can become, a fluctuation can be a minimum of 1, that is 0.001 to the last decimal or the last digit. So it can go up to 88.5026 minimum. Fluctuation would be this. It cannot be anywhere between 88.5025 something. If I say the price of the dollar was 88.50252, that is not possible. Why? Because the PIP is 0.0001. So you will make a fluctuation only up to 4 decimals. Anything is to be rounded off. So it means either the minimum fluctuation, if it goes up, will be by 0.001. So 88.5026 and 88.5024 if it goes down. Why this is important? Later on, when we'll be doing questions, when forward points would be given, swap points would be given, it would be very easy for you to understand how to calculate the price of a currency using these forward points or swap points. Another very interesting concept here is the exchange rate, which is expressed by a pair of currency in which none of the currencies is the official currency of the country in which it is quoted. Let's see an example. I have the price of USD against pound. Okay. And I have the price of USD against euro. Now the price of pound to euro is missing, right? So you have the price of USD to pound. 1 USD is equal to how much pound? Let's say this is 0.85 and 1 USD is equal to how much euro? For example, this is 0.90. But you want to find out the price of pound against euro, right? How will you find out? To find out this, you need the cross-currency rate. Why? Because it is expressed by a pair of currencies, but none of the pairs is the official currency of the country in which it is quoted. So how will we find the cross-currency rate? So what do we want? We want pound by euro. And if you will look at these quotes carefully, this is very intuitive way to calculate the exchange rate when using the cross-currency rates. You can see that euro, we need it in the denominator, 1 euro. And we have 1 euro in the denominator. Here we have, if I can write like this, it is how many pounds against dollar. This is how many euros against $1. So you can see you need the pound in the numerator and you need the euro in the denominator. So this was 0.85 and this was 0.90. So this you can use 0.85 multiplied by, if this I inverse, I make it dollar by euro. So what will be the quote then? 1 upon 0.90. You will get the price for 1 euro against pound. If you multiply these two, pound by dollar, multiplied by dollar by pound, euro, you will see that the dollars will get cancelled and you will have pound by euro as your answer. But for that, we see that we have dollar in the denominator in both the situation. So we want the euro to be in the denominator. Use this as it is. Pound by dollar and inverse the other one. So it is dollar by euro. Okay. And you will get the cross-currency rates. This will also be a very relevant concept when you will be doing the practical and numerical questions based on this. Sometimes whatever we are looking for, we will not get it directly. We will be using the cross rates. All right. So far, I have explained to you what is the different quotations. Here, we will talk about one more important concept, which is the bid and ask rate or the bid or offer rate, and what is the bid offer spread. So far what we have done is we have talked about rupee to dollar being 88.50. But generally what happens is the banks will quote or any other dealer will give two different rates for buy and sell. So they will give a different bid and ask. So if the bank or the dealer will quote to the customer rupee by dollar, let's say 88.30 oblique 88.70. It means if the customer wants to sell $1, the bid rate will be applicable. So the dealer has given a bid of 88.30. Whenever you are going to sell something, you will get less. But when you go and ask for the same thing, when you will want to buy it, you will have to pay a higher price. So who will want to sell $1? Think about it intuitively. Anyone who is a exporter. What will the exporter do? He will export goods to, let's say, USA. We're talking from the Indian concept. If you are an Indian and you have exported goods to the US and the invoice currency or the invoice in which the invoice is raised in dollars, the US importer will pay dollars to you. Now, you cannot keep those dollars in India. You have to convert it into your local currency or your home currency. So you will go to the dealer. You will tell them that these are the dollars I have and I want to convert these dollars into rupee so that I can use it in India. So any exporter in India would receive dollars if the invoice was in dollars, and then he cannot keep these dollars with him. He has to go to the dealer, get these dollars converted into rupee. So what the dealer will offer, the bid would be for 88.30. So the dealer will, customer will sell the dollars at 88.30, which is the lesser price as compared to the ask. Similarly, if the customer wants to buy dollars, the ask rate will apply. Okay. What is the ask rate here? The ask rate is 88.70. So if he wants to buy dollar, he will have to pay to the dealer 88.70 for every single dollar that he wants to buy. Who would be needing to buy dollars? Anyone who has imported something from US and India. Importer in India would want to buy dollars so that he will buy the dollars and will make his commitment to make the payment of the whatever the imports he has made in dollars. The difference, always remember that the ask is always higher than the bid. The ask may also be called as the offer price or ask or the buy price, whereas the bid may be called as the sell price. So bid or sell oblique offer, ask or buy price. These are the two prices generally the bank will offer to a customer or a merchant. Bid will always be less than ask. This is very, very important. If bid is not less than ask, there will arise an arbitrage opportunity. And the difference between the bid and ask, this difference of 40 points is called as the spread. You can see why I'm saying 40 points. If you have recall, I have applied the PIP. So it's 0.01. And how many decimal points did we shift from 88.30 to 88.70? It is 40 points. So the difference between the bid and the offer is called as the spread. Right? So foreign exchange quotes are two-way. Either the banks, interbanks or dealers, even for the merchants, it will be expressed as bid and offer. So bid is sell, offer, ask, buy is the ask rate. If you are a customer who wants to sell dollars, you will get lesser rupees against these dollars. And why would you want to sell dollars in India? Maybe because you have exported something to the US counterpart who has made the payment in dollars. Why would you want dollars in India? Why are you exposed, or why do you want to have dollars? Maybe because you have imported something from US and the currency in which the invoice is raised is dollar. So to honor your commitment, you'll go to an authorized dealer and will ask him to give you dollars. So you're going to buy dollars for 88.70. Right? So the price at which you will sell dollars is 88.3. The price at which you will buy dollars is 88.70 if you are a merchant. Ask is always more than the bid. Bid and ask are the rates which the dealer has quoted to the merchant. And the difference between the bid and ask is called as the spread. So this is the formula to calculate the spread. In the previous question, if you look at it, rupee by dollar, the rates quoted were 88.30 oblique 88.70. So what is the bid? 88.30. What is the ask? It is 88.70. How much is the difference? 0.40. On 88.30. So you can calculate what is the percentage of spread points are 40. And how much is the spread percentage? It is 0.4 divided by 88. So it is 0.453%. Right? So this is how you calculate the bid, the spread and the spread percentage. To recap, the difference between the bid and ask so you can call it offer, ask, or the buy price for the merchant. Bid is buy for the merchant and this is bid or sell for the merchant. So the difference between the bid and offer or bid and ask is known as spread. And you can calculate the spread percentage by subtracting bid minus offer divided by bid into 100. Next, very important concept. Now that we have understood that there will be two rates, one is bid and the other is ask. See here, it's not necessary to write down the complete 88.54. 88.53 oblique 88.54. These are indicative that it is 88.54. The pip points are written, that's sufficient to indicate the quotation. So if the spot rate is 88.53 oblique 54, it is indicative. The bid rate is 88.53 and the ask rate is 88.54. Then let's say after 6 months, the forward rate quoting should look something like 88.93 and 88.98. So this means that the price of dollar has increased from 88.53 to 88.93. That's the bid rate has increased by 40 basis point. And the ask rate has increased from 88.54 to 88.98. It is 44 basis point, right? So this is the forward rate. That means in future or in coming times, the dollar has become more expensive. But this is not how we write the market convention. We will not write the forward rate like 88.93/98. The forward rate is generally quoted with spot and forward margin separately. So we will write it as 40, the change in forward bid rate, /44, the change in forward ask rate. So forward rate is not quoted like this, but always quoted with the spot and forward margin separately. So 40/44. So we write the pip points and there we get the forward rate. So it's not a foreign exchange rate quotation, but it is just a difference. How many points have changed since the spot and forward rate? So if a forward exchange dealer will quote the 6 months forward rate as 40/44. By looking at this 40/44, we have to calculate the forward rate. Yes?
Madam,
Yes?
yeah, I think there is one Prithviraj has some chat the message that probably madam is not receiving my message. I tried on both the chat. Just check it out, madam.
I'll just. Okay. Yes, sorry, Prithvi. Yes, Prithvi, can you explain your doubt? Bid and ask. So you have a difference between bid and ask. The foreign exchange quotes are two-way quotes which are expressed as bid and ask. Offer or ask. So what is your confusion, Prithviraj? Can you just unmute and explain and let me know what your doubt is? Can you unmute and tell me? Yes? I'll explain again. There are quotes are expressed in two ways. One is the bid and the other is ask. Bid may also be called as sell and the ask may also be called as the buy. These are the rates which are offered by the banks. Okay, Prithviraj, you are not able to speak. It's okay. I'm trying to explain again. Let's see. What I'm saying here is the bank will give a two-way quote to the merchant. The first is the bid and the other is the ask. I hope this is clear that bid is always less than the ask. Right? Bid will always be less than the ask. Okay? Bid is the price if you want to sell dollars to the dealer. Bid is the price he will give you. 88.30/88.70. If I've taken these two rates as the bid and ask, if there is a exporter, think about it, an exporter will have given some goods to someone in USA. Therefore, this person will want, the person to whom you have given goods in USA will make the payment. Now, if the invoice currency was opposite in the sense, if there is, you want to say that bid is more than ask. Yes, Saransh or Prithviraj, you're saying something in that you're finding something different. Bid is the price to buy and vice versa. Okay. Bid is the price to buy and vice versa because bank is saying bank is buying and the merchant is selling. So this sell is from the merchant's perspective. And this buy is also from the merchant's perspective. The dealer is buying and the merchant is selling, whereas in the ask rate, offer or ask rate, the dealer is selling and the merchant is buying. Right? Is the confusion clear? I hope, Prithviraj, now it is clear to you.
Okay, madam, if no message has been received, so you can continue. No problem.
Right.
Okay.
Thank you, sir. So a foreign exchange quote will have two-way quotes, bid and ask. The bid and ask are from the in bank's point of view or from the dealer's point of view. The dealer is bidding and the dealer is asking. So when the dealer is bidding, the customer is selling or the merchant is selling. And when the dealer is asking, the customer is buying. The merchant will be buying. So 88.30/88.70. So if the customer wants to sell $, to the dealer, the bid rate will be applicable. 88.30. So if you are an exporter, you will be receiving dollars, which you will have to convert it into rupee by giving it back to the dealer or the authorized dealer or the person from whom you are converting your money into rupee. Similarly, if you are an importer, you need to make the payment in dollars, then you will require to buy the dollars from the dealer. For that, the dealer will ask 88.70 and you're going to buy it. Okay. So remember always that the bid is always less than the ask, or the ask or offer is always higher than the bid, and the difference is called as the spread. So these are the two rates, how you calculate the spread and the percentage of spread. This is how we have discussed. Next, we were talking about forward rate exchange quotation, how they are, what is the convention, how they are spoken or how they are written. So you will not get a forward rate quotation like 88.9398. You have to calculate the exchange rate by applying the convention. So the convention says it is 40/44, which means that the foreign exchange spot rate has increased by 40 basis point and 44 basis or pip points in the forward rate. So after 6 months, the price for dollar would be not 88.53, but you add 40 to last two digits of 53. 53 plus 40, 93. So you have 88.53 using the concept of pip points, and for 53 plus 40 would be added to last, and it becomes 88.93. Similarly, you will apply it to the ask. 88.54 was the rate, and you will add to this 44 points. Your ask will now become 88.98. So you are able to calculate the forward rate as 88.93 oblique 88.98. Okay. So one has to calculate the forward rate applicable by loading the forward margin to the spot rate. And the number of basis points from spot rate to arrive at the forward rate is also referred to as the forward points. This will also be called as swap points. So you have to look at that, right? Now, my question is, the forward points are equivalent to pips in the spot market. My question is, can you calculate the forward rate? If the rate is, if the forward quote or forward points are 44 oblique 40? Yes. What will be the answer? Will it be same? You can see that the swap points are not increasing. Here you can see it is 40 oblique 44. So this means you're going to add the swap points or the forward points here. But if you see that the forward points are decreasing, from 44 it has gone to 40. So when you see a decrease in the forward points in bid and ask, here in bid, how much was the forward point? 40. In ask, how much was the forward point? 44. So when the forward points in ask is more than the bid, it means that the spot rate is increasing and you have to add the forward points. But if you see bid is 44 and ask is 40, in that case, you have to see that the dollars is at a discount. The dollar price is decreasing. So now your new answer would not be 88.93 and 98. It would be 88.53 minus 44. It will become 88.09. And ask 88.54 minus 0.40 will decrease the 40 points from here, and the ask will be 88.14. So the new forward rate would be 88.09 oblique 88.14. Okay. So very important thing here, you have to look at the forward points or the swap points. If you see the ask is more than bid, you have to add the forward points. But if the ask is less than the bid forward points, that means you have to subtract the pip points or the forward points or the swap points from the current spot exchange rate. 88.53 minus 0.44 and 88.54 minus 0.40. Here we come to a concept which is that if the pip points are 40, 44, we see that the price of dollar has increased and we say that dollar is at premium. But if you see that the price of the dollar has decreased from 88.53, it has become 88.09. From 88.54, ask has also fallen 88.14. Then we say that the dollar is at discount. It is depreciating. So let's understand the concept of premium and discount. We'll continue with the same price. So rupee, dollar, which was, I'll keep one single quote here. Let's say 88.50 becomes, after 3 months, 88.80. Do you see an increase in the dollar price? The answer is yes. It means that dollar is at premium. The price of dollar has increased, indicating dollar is at premium. How much premium? How do you calculate? Forward rate minus spot rate divide by spot into 100. This is the dollar percentage premium. So how much it has increased? I would want everyone to use your calculators simultaneously so that you also keep on calculating the answers if you have understood. So what does it come out to be? 0.30 divided by 88.5, right? So the dollar is 0.3389 or 33, we can say 0.34%, round off. Right, Geeta, very good, excellent. Point 3389, perfect. Good. Ankit. Right. So some of you given good answers. So 0.34% or 0.3889%. This is the premium. Now, very important concept here is if dollar is at premium, it implies rupee is at discount. Right? Another very important thing here is the dollar is at premium of 0.304%, but you can also annualize it. It is only after 3 months. So when you analyze it, 0.34 multiplied by 12 divided by 3. So if this is the premium for 3 months, for 12 months, the premium would be 4 times the existing. Yeah, so it will be 1.36%. Perfect, Sandeep. Very good. So if dollar is at a premium, it also indicates rupee is at discount. Now the question is the discount on rupee also 0.34% for the 3 months and 1.36% per annum? Yes? The answer is no. It's not that you can say that if dollar has appreciated by 2%, rupee has depreciated by 2%. If dollar is at premium by 2%, rupee is at discount by 2%, you will not get the exact same figure. There will be small difference. Okay? Let's understand the logic. First, let's take the same rates and calculate the discount. So you had rupee by dollar, which was 88.50, and rupee by dollar after 3 months, which is 88.80. We calculated dollar at premium. For 3 months, it was 0.34%, approximate to 2 decimals. Let's see the discount on rupee then. One way is, this is for explanation. Dollar by rupee was 1 upon 88.5 inverse quote, and dollar by rupee after 3 months one upon 88.80. So when you calculate the inverse quote, 1 divided by 88.5, you end up getting 0.01129. We'll keep it 3. And 1 divided by 88.80, 0.01126. Calculate the discount percentage using the same formula. Forward minus spot divide by spot into 100. 0.0113 minus 0.1126 divided by 0.0113 into 100. Okay, great. Sandeep has already calculated. So this comes out to be sorry, I have we can keep this also till 4 decimals. $354%. And if you will annualize, it will come out to be 1.4 something. Okay, so the discount didn't come out to be same. So one of the ways, this means that dollar was at premium, rupee is at discount. So one inference we draw from here is that by using this formula, you get the premium or discount. Sorry, it would be 0.01126 minus 0.0113, not the other way around. You get the premium or discount, and because our answer is in negative, we can see it is a discount. So first important point is you get the premium or discount on the denominator currency or not the reference currency. The currency which has been taken as the base, not the reference. Okay. So here $1, $1. So we were getting the premium on dollars from 88.50 to 88.80. Similarly, when we got the inverse code and we calculated the inverse code by dollar by rupee, we are getting the discount on rupee. Because it is negative, we could make out that this is a negative or a discount. So first thing is when you apply this formula, forward minus spot divided by spot into 100, you get the premium or discount percentage on the denominator currency. If it is positive, it is premium. If it is negative, it is discount. The second important thing is you could have used the same formula using these codes only. Forward minus spot, divide by forward. So instead of dividing by spot, we could have divided by forward and we would have got the same answer. So look at this, 88.80 minus 88.50 divide by 88.80. So you will get the same answer as the discount on rupee. Okay, we got some answers here. Good. 3539. Yeah, right, Geeta. Right? So this is how you calculate the premium or discount on a currency. When you use forward minus spot divided by spot into 100, you get the premium or discount on the denominator currency. Positive indicates premium, negative indicates discount. But if you want to find out the premium or discount, or rather discount or premium on the numerator currency, one way is you calculate the inverse quote. And the second thing is then you apply the same formula. Alternatively, you can also use the formula forward minus spot divide by forward into 100. Okay. And you will be getting the same percentage of discount on the numerator currency. Okay. Any questions so far? All right. Now, we have seen that sometimes the forward rate increases, sometimes the forward rate will also depreciate, or the currency will also depreciate. They will decrease also. So why do the forward rate increase or the forward rate decrease? One of the very important reasons is if we keep all other things constant. There are many reasons why we have changes in foreign exchange over a period of time. Why do the foreign exchange rates change? You must have seen dollar was never not 88.50 or 88.89 throughout. There were times it was also 16. There were times when it was 35. Then were times when they were 50, 55, 58, 60, 69. And we have seen that the dollar is constantly appreciating, or the dollar is continuously at premium in context to the Indian currency. So over a long period of time, it has gained gradually. So there are different factors which makes changes, because of which there are changes in the exchange rate. And one of the most important factors is the interest rate. One of the important factors is also the inflation, the price changes in the current country. So inflation and interest, they play a very important role in the exchange rate determination in forward rates. Apart from this, there can be many other factors. The way the geopolitical movement is going on nowadays, there is nothing, nobody can be untouched or unaware of it at present times. In the earlier times, if what is going on in US, in Germany, in UK, Iran, USSR or US, Russia, Ukraine war is going on. So many things are going on. So we are all aware of how things are being impacted in India as well as a country. So exchange rates are not determined by only these two factors as interest and purchasing power. The exchange rates are also influenced to a greater extent by other reasons also, like what is the government policy, what is the tax rates, what is the trade barriers, like we have seen a lot of trade barriers and tariff rates being imposed on different countries, particularly by the US. So all these will definitely play a great role, immense role in the calculation of exchange rates against two currencies. However, we'll still stick to the two very important aspects, which is interest rates and the inflation. When we say why the exchange rate fluctuates with interest, and that is to keep the interest rate parity. We don't want to have an arbitrage opportunity created in a way. So we want that there should be interest rate parity. Second important aspect was inflation. So we want that purchasing power parity also to exist. Nobody should be able to exploit or take any arbitrage opportunity or advantage using the changes in the inflation. So we have two concepts here, interest rate parity and purchasing power parity, which are very, very important determinants of why the exchange rate fluctuates. Here, we will look at it in deeply with a lot of examples. But before that, understand one thing. What is the interest rate prevailing in India at present, for example? The RBI repo rates are around 5.5, and the other interest rates that are prevailing is generally in the banks when you go for fixed deposits, etc. It is 7%, 8%, right? Somewhere between that. However, if you look at the European nations, if you look at the US country as a country, the interest rates prevailing there are comparatively much less, 1%, 2%, 3%, so on. And we have also seen and witnessed a continuous increase in the prices of the different currencies as against the Indian rupee. We have seen dollar increasing tremendously over a long period of time. We have also seen the euro, the pound, every other currency in Europe and in US being at a premium in compared to the Indian rupee. So why? Because there the interest rates are lower, and here in India the interest rates are comparatively higher. So when you have a higher interest rate, what will happen is if the exchange rates will not fluctuate, people in US will convert their dollars to rupee, will invest it in India, get 7 or 8% return, and then get reconverted into dollars. So what will happen? A lot of money will come in India for investments. So what we will require? Rupee will be in demand and dollar would be sold. So when it's a play of demand and supply also, one of the reasons why the interest rates fluctuate. So when there is more demand for rupee, less demand for dollars, and dollars would be sold, the price of rupee will increase, right? So it cannot be that the currency remains same, and as the demand will increase, there would be changes. So similarly, if the USA had offered us more rate of interest, what would have we done? We would have converted our rupees to dollars, and then dollars would be invested in US. Then we got a higher return, let's say 10%, convert that amount together with interest back to rupee and bring it in India. So we would have ended up getting more in terms of interest rate as compared to the other Indians who have not taken this route. So what will happen like this is, if this thing persists over a long period of time, equilibrium will be returned. Nobody should be able to make this arbitrage profits. Here we are assuming one particular thing, that all other things are constant. There are no transaction costs. There is nothing else. Other costs are not there in converting the rupee to dollar or to dollar to rupee. So this is the interest rate parity will not allow this to happen. Whatever the differences in interest rates will be automatically adjusted because of the conversion or because of the fluctuation in the exchange rates. So the forward points represent the interest rate differential between the two currencies, and you will witness that the currency where the interest rates are lower, that currency will always be at premium. Why? To compensate the lost interest in the form of increase in exchange rate versus the other currency. Okay? So we will go through the interest rate parity. You have to understand that interest rates are not same in two different currencies. There is central bank, which regulates the interest rates in different countries. In India, the central bank is RBI. In US, it is the Fed Reserve. So interest rates are not same in two different countries. And let's say in US, the interest rates are 2%. And in India, the interest rate is 8%. So, if the forward rate after 3 months is to be calculated. And spot rate I'm not giving the bid and ask both, I'm just giving one rate. So if the forward rate after 3 months is to be calculated and spot rate is rupee by dollar 88.5, what should be the forward rate? What will it be? Would you like to give it a try? Okay, I'm giving you a 10 minutes break here. Okay. And you can also, those of you who want to try this answer can try and paste it in the chat window in the meantime. Okay. Continue to share the screen so that you can keep looking at the question, but we're going for a 10 minutes break. Also, do let me know if you're understanding everything clearly. Please type in the chat window if you have any doubts. Okay. So it's 8:32. You can be back by 8:42. Okay. we were on talking about the interest rate parity. The forward points will represent the interest rate differential between the two currencies. And we will see that the country or the currency which has lower interest rate, that will always be at premium versus the other currency. So I've given you a question. Let's say the interest rates in US is 2% and the interest rates in India is 8%. If you want to calculate the forward rate after 3 months, and the spot rate is given as rupee by dollar 88.50. So $1 is equivalent to 88.50 rupees. What will be the forward rate? For this, we use this concept or the covered interest rate parity equation. Now, if you look at this, you can see that the rate of interest in the D domestic currency and RF is the rate of interest in foreign currency. Now, as we have seen that the RD is higher, particularly if you look at the Indian context, it is 8% annual. So it should be equal to 2% in foreign currency, rate of interest of US, right? How can 1.08 be equal to 1.02? It has to increase by some number. So this is the factor by which we will multiply. And because this has to be increased, this factor has to be greater than 1. Indirectly implying that the forward rate will always be greater than the spot rate if this interest is lower. And if forward rate is greater than the spot rate, it also implies that the foreign currency is at premium. Looking at this equation, we can also calculate the forward rate from here. So the forward rates will be equal to spot rate multiplied by 1 plus rate of interest in domestic currency divided by 1 plus rate of interest in foreign currency. So if we want to calculate the 3 months forward from the given data, so spot was 88.50. The rate of interest in domestic currency is 8%, but 8% is per annum. And we are going to calculate the forward rate for 3 months. So 8 divided by 4, there are 4 3 months or 4 quarters, 2% for the 3 months. So it will become 1.02 divided by the rate of interest in US is 2% per annum, which makes it 0.5, 0.5% for 3 months. And 0.5% when expressed in decimal will become 1.005. So when you calculate the forward rate, 88.5 into 1.02 divided by 1.005. The forward rate comes out to be 89.821, 8209. Students, you will remember to take the calculate your answers up to 4 decimal points until and unless it is specifically mentioned some other. So it's 89.8209. You can see 89.8209 is greater than 88.50, indicating that US currency is at premium. If this will not happen, there will be arbitrage opportunities, which should not happen. So to avoid any arbitrage opportunity, the interest rate parity hold good or covered interest rate parity, which means that whatever the loss of interest is there to a US citizen in terms of the percentage of interest is compensated by appreciating his currency. Okay. I'd like to explain to you how this arbitrage works if it is not 89.8209. Let's say it remains 88.50. So, firstly, let's say if the forward rate was also 88.50. What would happen? India has an interest rate of 8%. US will have an interest rate of 2%. A US citizen will feel like to invest in India. So what does he do? He borrows $1 in US at 2%, converts into rupee. Second step. So you will borrow in the country where the interest rate is less and invest in the country where the interest rate is higher. So the US citizen will like to invest in India and he will borrow $1 in US at 2%, convert it into rupee. It will become $1 will convert to 88.50. Invest in India, let's say for complete 1 year or 3 months. So 88.50 will become 88.50 into 1.02. They will become 90.27. And in the US, he will have to pay $1.005 after 3 months. He has borrowed $1 in US. So after 3 months, the rate of interest is 0.5%. So 0.5 divided by 100 will be 0.005. So he will have to repay $1 together with interest of 0.005. And so he has to pay $1.005. Now, to get $1.005 and the exchange rate remains 88.5 only, he will have to pay 88.9425 rupees to get the $1.005. Okay, how we calculated this? 1.005 multiplied by 88.50. So he will pay 88.9425. But how much is he getting in hand? 90.727. So he will make an arbitrage profit of 1.3633 approximately. Okay, so which should not be possible. Now let's substitute the rate of 89.8209 instead of 88.50. 89.8209, and that if you will multiply by 1.005, you will end up getting exactly 90.27. So if forward rate remains 88.50, a person will get an arbitrage opportunity. How? He will borrow $1 in the US at a 2% rate of interest, convert it into rupee, it will become 88.50. Invest in India at the rate of 8% per annum. So after 3 months, he ends up getting 2%. 88.50 into 1.02, he ends up getting 90.27. Now he has to repay the US lender at the rate of 0.5% interest for 3 months. So he has to pay $1.005 to buy $1.005 against rupee. If the rate remains 88.50, he will have to pay 88.9425 only. So he has not invested anything from his own pocket, right? He has not invested a single rupee. He has borrowed at 2% per annum, equivalent to 0.5% for 3 months, and repaid after 3 months together with interest how much he has repaid? $1.005. So if the forward rate remains 88.50, he ends up paying 88.9425 rupees for the same, whereas by investing that money in India, at 8%, he ended up getting 90.27 rupees after 3 months. So the difference is his arbitrage gain. Now, instead of 88.50, if we multiply the 1.005 with the forward rate we just calculated, 89.8209, you will end up getting exactly 90.27, which means either you invest $1 in US or you invest 88.50 in India, you end up having the same results, right? So no arbitrage opportunity would be there if the foreign exchange rate adjusts itself to the interest rate. So interest rate parity theory, I hope it is clear. It means the size of the forward premium or discount should be equal to the interest rate differential between the two countries of concern. When interest rate parity will exist, covered interest arbitrage will not be possible because any gain or advantage in interest in the foreign country's currency will be offset by the discount on the forward rate. So you invest in rupees in India trying to get 8%, but the rupee will get into a discount. There will be a discount on rupee. The forward rate exchange premium would be there on US dollar, whereas the rupee would be at discount. to compensate so that now when you reconvert it into dollars, you don't end up getting extra. So the act of covered interest arbitrage would generate a return which is not higher than as would have been generated in the domestic investment. Okay. So then the covered interest rate parity equation was given by this formula. Just imagine if the rate of interest in India is 1%, so 1.01, and this is 1.02. So forward would be less than spot. That means then rupee will be at premium. All right. So these are some of the basic concepts which will be relevant for you to understand the entire concept of the foreign exchange exposure management, risk management. A quick recap of whatever we have done so far. We have talked about the exchange rates. We have talked about direct, indirect quote. We have talked about American and European quote. We have also discussed about the difference between the bid and ask, how to calculate the spread between the bid and ask, percentage spread, looking at which currency is at premium, which currency is at discount, and also finally checking out that it doesn't mean that one currency which is at premium of 2% is exactly means the other currency is at a discount of 2%. So either you use the formula for forward minus spot by spot into 100 to calculate the premium or discount on the denominator currency. And then you, for the other currency, either you calculate the inverse quotes first, else you can do one thing, you can change the formula from forward minus spot divide by forward to calculate the discount or premium on the numerator currency. Right? One small concept, another important concept is when you calculate the inverse quotes, always be careful about one very important thing. So if the rupee dollar bid ask rates are 88.2 oblique 88.8, then dollar rupee, when you will do the inverse, it will be 1 upon 88.80 oblique 1 upon 88.20. Okay, so this, it will be 1 by ask, 1 by bid. If you ever have any confusion in this, just remember the simple concept. Bid is always less than ask, and when you divide a number with a higher number, only then you get the answer which is less than this. So the first bid has always to be divided by the higher number. Okay, and ask will always be the higher. So dollar rupee bid ask will be calculated as 1 by ask upon 1 by bid. Then we also understood how forward points are calculated. If they are increasing, we have to add. If they are decreasing, we have to subtract. Then we have also seen the cross-currency rates may also be required to be calculated. All right. Now we can move on to some questions, team. Let's look at this question. You have the assignment, so let's start doing that. Indian rupee is the home currency and foreign currency is the US dollar. What is the exchange rate between Indian rupee and US dollar? We'll talk it in terms of, like at present, what is the rate? One way we can write is rupee by dollar. Okay, let's say the current rate is 88.5 or 88.70. If you want to give bid and ask both, you can say 88.70, 89.00. Here we have taken the pip points 0.01. We could have also expressed it as 88.7005 oblique 89.00. 0.0010. Here we have taken the pip points. It can also be expressed as the code which has been given, USD INR. Here it indicates 1 USD is equivalent to 88.70 INR when you are going to sell USD. So you end up getting 88.70. Sell USD means as a merchant. Equivalent to dealer will buy. USD INR, if says 1 USD, or this could be written like 1 USD 88.70/89.00. But to explain the bid and ask again. So when you have to buy USD as a merchant, who is buying the USD? Merchant. Indirectly, the dealer is selling. Okay.
Ma'am, for the given currency, we can also quote, as we have previously studied, the direct quote and indirect quote.
I'm coming on to all that, right? So here, the way we have quoted this is a direct quote for an Indian. The indirect quote for an Indian would be one upon 89.00 oblique 1 upon 88.70. Can be written as dollar upon rupee or INR oblique USD. So this will come out to be 0.01124, or I can take it as 0.0112 oblique with 4 pip points. I'll take 5. Okay. So this is the quote. This becomes a indirect quote for an Indian, or a direct quote for a US citizen. This is also a American quote, and this one is a European quote. Right? Any doubts here?
No, ma'am.
Okay, great. Next question. Prevailing rate of exchange is 1 USD is equivalent to rupee 50. Which is the reference currency here? Quickly type in the chat.
USD, ma'am.
US. Are you sure?
Yes, ma'am.
1 USD is equivalent to rupee 50. 1 USD is equivalent to 2. 1 USD is equivalent to rupee 0.8. 1 USD is also equivalent to rupee 5. One USD is equivalent to 1.2. One USD is equivalent to rupee 50. Right? That's what is given.
Yes, ma'am.
Which one is correct? Which one is correct here? This is correct. This is correct. This is correct. This is correct. All are correct. Why? If this is against rupee, if this is against Canadian dollar, if this is against, let's say, pound, if this is against, let's say, French francs. So which one is the reference currency? 1 USD is equivalent to rupee 50 when you are referring rupee. 1 USD is equal to 1.4 Canadian dollar when you are referring the Canadian dollar. 1 USD is equal to 0.88 when you are referring the pound. 1 USD is equivalent to 12 when you are referring the French francs. 1 USD would be equal to something else when you are referring it to Japanese yen, JPY. Got it? So the reference currency is, can I have the answer now? Here,
the currency at which we refer per.
This is constant. So we are referring 1 USD with reference to rupee. Clear? Okay, you go to a shopkeeper and you ask for the price. He has to specifically tell you that the price for book is 700 rupee. The price for other things. So for different things, he is giving you the price, right? So he's referring the price of different things with reference to what? So similarly, see, I think in the very first slide, we talked about reference rate. Yeah. For example, the rupee dollar exchange rate is the number of rupees that $1 will buy. So if a dollar will buy rupee 88.50, exchange rate will be expressed as rupee 88.50 per dollar, and the rupee would be the reference currency. Okay, what is constant here? The USD is constant. So we are referring the price with reference to rupee, then it is 50. If we are referring the USD price with reference to Canadian dollar, then it is 1.540. Okay?
Yes, ma'am. Yes, ma'am.
So the reference currency is the rupee here. So once again, how would you express the exchange rate as a direct quote and an indirect quote? I think that is clear.
Yes,
Assuming home currency is rupee. So direct quote would be rupee by USD. Either you write it like this, or you may also write it like USD/INR. This is a direct quote for a Indian. Right? Indirect would become?
Ma'am, INR per dollar, no?
No, when we write the symbol here, this is numerator by denominator. This is rupee by dollar. But when you use the code, generally it is given internationally. All currencies will have a code also, a symbol and a code. Like India has rupee as the symbol and INR as the 3-digit code for the currency.
Ma'am, I am understanding, but it will be INR by USD, no?
If you write it like this in the code, this is 1 USD, how many INR equal to 50? This is how it is read, convention. Okay? But if you're writing the symbols, you can write rupee by dollar. Here, $1. Okay? Don't get confused. If you're using these, the currency which is coming first is generally 1. Reference currency is the other one. Okay? It is not USD by divided by INR, or not writing it in numerator divided by denominator. This is numerator and denominator. This is not numerator denominator. 1 USD oblique INR 50.
Okay, ma'am.
Okay. The same thing could have been written as indirect code. Dollar rupee equivalent to 1 divided by 50, that's 0.02. And it could have been written as INR, 1 INR, USD 0.02. Okay? Clear? Can we move on to the next?
Yes.
All right, thank you. Okay, this is one good question. I would like you to think about it for 2 minutes. Yeah, thank you, Geeta. And then I'll explain. Just read it, think about it for 2 minutes, and then I'll explain. The price of a bond just before a year of maturity is $5,000. Redemption is 5,250 at the end of the said period. Said period is year. Just before a year, it was 5,000. And after 1 year, it is 5,250. Interest is $350 per annum. The dollar appreciates by 2% during the said period. Calculate the rate of return. Will the rate of return be, first calculate the nominal rate of return. Will the actual rate of return be higher or lower? All right, looking at the ambiguity of the question. So I'm starting to explain this. Looking at the ambiguity of the question, if you say, the price of the bond was $5,000, redemption value is 5,250, and interest is $350. So you can easily calculate how much is the return.
5% would be the return.
5%.
Yeah, 5250 minus 5,000 upon 5,000.
Okay, yes. 5250 minus 5,000. That's the principal gain.
Ma'am, we can also include 350 na,
Plus 350, yes.
but it's for per annum.
So we are calculating the return
Per year
also.
as well. It's come to 12%, ma'am.
Yes, it will come out to be 12%. Perfect. So by investing 5,000, how much you gained? You gained interest of 350 and a capital gain of
Depreciation of 250.
So it's 600 by 5,000 is the return, which implies it is 12% for the annum. Right? All of you agree to this?
Yes, ma'am.
There is one catch. This is if you are a US citizen. Okay. Okay. If you are a US citizen, then this nominal rate, this return is okay for you. But what if you were an Indian? Let's assume some other country and let's assume India. Then also, do you think is it 12% or something else? Here, have you made any use of this information? Dollar appreciates by 2%. So this information will be relevant if you are from someone apart from US. If your normal currency, home currency is not dollars, you are maybe residing in India, so your home currency is rupee, or residing in Germany, your home currency could be euro or Dutch mark. If you are residing in UK, it's the British pound. Okay, Singapore dollar if you are in Singapore, Australian dollar if you are in Australia. If you are in Canada, Canadian dollar. If you are in Hong Kong, Hong Kong dollar. So whatever the different country you are in, it's not your home currency. Dollar is not your home currency. And against your currency, the dollar has appreciated by 2%. So what is your rate of return? All right, before we calculate this using a formula, let's understand it. Taking a example or taking a simple rate for rupee to dollar. Okay, so let's say the rupee by dollar is 50. For simplicity, I've kept it 50. Okay. Now you want to invest $5,000 today. So how much rupee do you need?
25, 250.
Right. So rupees required to invest in dollars, to invest $5,000. You will need 5,000 into 50. With 2,50,000 rupees. So you go and get 2,50,000 rupees, convert it into USD, you get 5,000. This USD then gives you a return of 12%. So first you arrange for rupees, convert to dollars, step 2. Step 3, invest. Step 4, return 12% after 1 year. So you end up having in your hand $5,600 year end. Okay. Now you need to convert $5,600 back to rupee in your home currency. Okay. Convert. What's the exchange rate? Dollar is in denominator and dollar has appreciated by 2%. So you can simply apply the formula. Dollar appreciates by 2%. So you can simply increase the price of dollar. $50 into 1.02, it will become 51. Convert your $5,600 into rupees. How much you end up getting?
$285,600.
Now what is your return? $35,600, right?
Yes.
2,85,600 minus 2,50,000. So you end up getting 35,600 by investing 2,50,000. Calculate the return.
It will be 14.24%.
Right. Okay. So what was your real return? Not just you gained because you got interest. You got capital gains, but also because you invested in a currency which appreciated. So another 2% for that. So if you did not want to go through all this calculation to actually understand, we could see that your 1 rupee had become 1.12, 12% return, right? And this further appreciated because of the currency in which you invested has appreciated. So when you'll do this calculation, you will end up getting, most probably you should be end up getting
1.1424, that is 14.24%.
Exactly. So once again, your 1 rupee becomes 1.1424. So your gain is
14.24.
0.1424 on 1 rupee. So as a percentage, it is multiplied by 100, 14.24%. Got it?
Got it, ma'am.
Yeah. So don't have to actually go through the entire thing, like assume an exchange rate and then convert it, reinvest it, get the returns, get it converted again using the newer current rate after appreciation, and then find the gain. Don't have to do this. Simply because the US dollar appreciated, you could multiply it by 1.02. If the dollar has depreciated, you could have multiplied it by 0.98, 2% less. Okay? Right? Any questions? Any doubts?
No, ma'am. Clear, ma'am.
Great. Yes, Gitika has also said 285,600 and 35,600. Good job, team. All of you are responding. Great. Can we move on to the next question then?
Yes, ma'am.
Okay. When I'm taking the next question, I need you to explain a little bit about certain accounts which are Nostro account, Vostro account, Loro accounts. I will do that, but just have a reading at this question, ignoring Nostro account as of now.
Okay, ma'am.
ABN AMRO Bank, Amsterdam. Amsterdam is a capital of which country? Where is Amsterdam? Europe. It's the capital of Netherlands. Okay. So ABN AMRO Bank, Amsterdam, wants to purchase rupee 15 million against US dollar for funding their Nostro account with Canara Bank, New Delhi. New Delhi is the capital of which country?
India.
Great.
India.
Good. Okay. So Nostro account with Canara Bank in New Delhi. So we have someone in India here. Okay. We have Canara Bank here. And we have someone here in Netherlands. I'll keep it broader, Europe. And we have ABN AMRO Bank here. So this bank has maintained some account with the Canara Bank where it is keeping money in rupee. So the Canara Bank in India is having an account of ABN AMRO Bank where the ABN AMRO Bank is keeping their money in the Canara Bank in rupee. This account is called as Nostro account for ABN AMRO Bank. So Nostro account is basically my money with you. So ABN AMRO Bank can say to the Canara Bank, my money with you in your country's currency. Understood what is a Nostro account? My money with you. So what has ABN AMRO Bank done? it has maintained a Nostro account with the Canara Bank in India, where it is keeping money in rupees. So if the ABN Bank, Amro Bank needs to make a payment on behalf of a client to someone in India, that can be done through the ABN Amro's Bank, the Canara Bank in India. The same account for Canara Bank is Vostro account. Vostro says your money with us. With me or with me, us. So for ABN Bank, this is a Nostro account. That's why it's saying ABN Amro Bank, Amsterdam wants to purchase rupee 15 million. They have to purchase 15 million to keep here. 15 million rupee for
Ma'am,
funding their Nostro account. So ABN Amro is calling it a Nostro account. Yes.
ma'am, for Nostro account, I like it for me. My money in some Bank of America. It will be Nostro account, no?
It will be a Nostro account where you're keeping the money in dollars.
Okay.
In the home currency of that country.
Okay.
So if SBI keeps account in Citibank US in dollars, for SBI it is Nostro. Okay.
Okay, ma'am.
For Citibank US it is Vostro. So in simple words, Nostro means my money with you. Vostro means your money with me in my country's currency. Loro means their money with you. So let's say if the payment was supposed to be made by some bank in Europe, let's say the Deutsche Bank the Deutsche Bank wants to make a payment in Germany. The German bank wants to make a payment to someone in India. But the Deutsche Bank does not have a Nostro account in India with Canara Bank or any other bank. So Deutsche Bank requests the ABN AMRO to make the payment on their behalf. So their account with you. So Deutsche Bank is saying to the Canara Bank, please make the payment from the ABN AMRO's account, which they have with you. And they will settle amongst themselves. Okay. So one is Loro. Loro means their account with you. Third party comes into picture. Okay. So when I have my money with you in your country's currency, it's a Nostro for me and Vostro for you. Okay. Because you are saying your money with me. Whereas a Loro means their money with you. Okay. So this is a small concept. We'll talk about it in detail later also. But let's just take up this question for as of now. So ABN, taking it in the perspective of the foreign exchange that we are discussing. So ABN Amro Bank Amsterdam wants to purchase 15 million rupee because they want to fund the Canara Bank account which they have in India, a Nostro account which they have in India. Now, assuming the interbank rates for US dollar is rupee 51.3625 oblique 3700, which means the bid is 51.3625 and the ask is 51.3700. What would be the rate Canara Bank would quote to ABN Amro Bank? What will be the equivalent dollar amount?
Yeah, 51.3700.
Will that be the rate applicable? Okay. I'll write these figures 51.3625. Requirement of ABN AMRO Bank is to buy rupees. $15 million for the Nostro account. Alternatively, we can say the requirement is also for Canara Bank to get the account amount in their bank in rupee. So to sell the buy rupee means sell US dollar. Right? For Canara Bank, it is Vostro account. So this is the second part of the question. Then how many USD will it become? 15 million rupees, okay. How many USD it will become? That will become the second part of the question. But first I have to check the rate which is applicable to buy the rupee or to sell the USD. These are the interbank codes. These are not a merchant codes. These are the interbank codes because what is happening is banks are involved. But anyways, if the ABN AMRO will buy rupee, someone has to sell dollars. Against dollars it is saying, right? Read again. ABN AMRO Bank, Amsterdam, wants to purchase rupee 15 million against US dollar for funding their Nostro account with Canara Bank. So when ABN AMRO will buy rupees, Canara Bank will sell USD. And assuming that the interbank rates are this, interbank rates. So Canara Bank has to
Sell.
sell.
51.3700.
Think about Canara Bank as a merchant. It is his requirement to sell. So interbank rate, he is the seller. For a bank merchant to be a seller, which rate is applicable?
51.3700.
Okay. Let me say, I have to sell dollars. Okay.
So in that case, it would be 51.3625.
If I have to sell dollars, it is 51.3625 because bank will pay me less. They will not pay me more. They will pay me less. So I have to sell. So from bank side, it's buy. This rate will be applicable. Is it clear?
Okay. Yes.
And now, because Canara Bank is also behaving like a merchant, it's his requirement. So these codes are not for merchants, these are interbank. So even in interbank, when one bank will go to another bank to buy or sell his requirement, to fulfill his requirement, for him also, it's like a merchant, the same rates will be applicable. So Canara Bank wants to sell US dollar. So for him, the rate applicable would be 51.3625. ABN, or we can say ABN AMRO wants to buy. Okay. Like a customer, he wants to buy. But is it the rates for rupee? No. He wants to buy rupee. These are the rates. For him, it is an indirect code. Right?
Yes, ma'am.
So let's convert it into direct code. Dollar by rupee. It will be 1 upon 51.3700 oblique 1 upon 51.3625. Okay? Right? Now, if you want to buy rupee, which rate will be applicable? Yes, you can unmute and answer. Which rate would be applicable if you want to buy rupees as a merchant?
1 upon 5, 51.37.
Right. This rate will be applicable. Now you want to buy the rupees. As a merchant, you are going to buy the rupees. So ask. When your requirement is to buy, ask. When your requirement is to sell the denominator currency, bid. When your requirement is to buy the denominator currency, ask. Okay. Easy now? You want to buy, so you have to pay more. And this figure is more. Ask is always greater than bid. And when you're going to sell something, you will get less. Always you can, if you get ever confused, think about it in terms of gold. Okay, let's say the gold prices are 1,10,000, for example. So if you want to sell the goldsmith will say, no, it's only 108. But if you go to buy the gold, he will say, no, the prices have increased. It has become 1,12,000, right? So whenever you're going to buy something, you will get it more costly. But when you go to sell the same thing, you might get lesser amount. That's why bid is always less than ask. Ask will always be greater. This is very important for you to understand in the very inception, because later on we will also talk about banks being charging the margins over this. So when you are going to add margin over this, you will have to add. But when the bank will charge a margin over the bid, you will get further less. So margins are to be added in ask, margins are to be deducted from bid. Okay? I'm not sure if all of you have understood. So let's just once again go back to question. ABN AMRO Bank Amsterdam wants to buy 15 million rupee. The requirement of ABN AMRO is to buy rupees. But the quotes for rupee is not given here. So let's convert it into inverse quotes. We are doing it only for the sake of simplicity. In exam time, we are not going to do this. We are directly going to read from here. Buying rupee is equivalent to selling dollars. So when you are selling dollars, bid will apply. 51.3625. Okay. But here, let's convert it into first inverse quote. And when you convert it into inverse quote, 1 upon ask oblique 1 upon bid. So you get 1 upon 51.3700, which will be a smaller number as compared to 1 upon 51.3625, which will be a bigger number. Ask is always greater than bid. Okay. So now you can say you want to buy rupee. What will apply? What will apply?
3625.
Yeah, ask will apply 51.3625. Okay. If you want to sell rupee, bid will apply. If you want to buy rupee, ask will apply. If you want to sell dollars, bid will apply. If you want to buy dollars, 51.37. So this is the same thing. Buying dollars, 51.37, equivalent to selling rupees, 51.37.
I have that.
Confused?
I have a doubt.
Yes.
In Canara Bank, sell US dollar.
Canara Bank's requirement is to sell US dollar.
So, in Canara Bank, denominated Canara Bank have a rupees, na? How can
Canara Bank wants to have rupee against dollar because ABN AMRO Bank is saying that fund my Nostro account with the rupees. They don't have it. And how did ABN AMRO fulfill their requirement? Through dollars. They are not giving, ABN AMRO is not directly giving Canara Bank the rupees, right? That's okay. Canara Bank is an Indian bank. It will have rupees. But it
Yes,
is
ma'am.
holding an account of ABN AMRO in Amsterdam.
Okay.
And ABN AMRO wants to give rupee to Canara Bank, but they don't. So they have to provide the rupee, but they are providing it not directly the rupee. They are providing in terms of US dollar. So it's the ABN AMRO's requirement for 15 million against US dollar for funding the Nostro account. But the Nostro account is with Canara Bank. So Canara Bank has to do it for ABN AMRO, right?
Yes. Okay. Clear.
As an agent, Canara Bank will buy 15 million rupee and sell US dollar indirectly. Okay.
Yes, ma'am.
So now Canara Bank is not going as a bank, it's going as a merchant. So it will not go to the normal market, it will go to the interbank market, right? The place where two banks are trading or exchanging currency with each other, right? That rate will be applicable. So the interbank rates are the rates which are applicable for the two banks, whereas the mercantile rates are the banks which bank offer to the other customers, exporters, importers. Okay?
Yes, ma'am.
Right? So ABN
So
AMRO's
in this, ma'am, yeah, in this question, ABN AMRO Bank sells US dollars to Canara Bank. That's why the rate is
Canara Bank will sell it.
51.3625.
Right.
So they convert it to 15 million rupees. Yes.
Right.
Then fund their account. Yes. Okay.
Definitely. Got it? Right. So 151.3625 would be the applicable rate. Now you can use the unitary method also here. So he has to sell $51.1 and against $1 the price is 51.3625. So if you had sold 51.3625 rupee, you would have to give $1 and 1 rupee is equivalent to 1 upon 51.3625. So this is how also you can get if you apply the unitary method, then also the same thing comes. Now, but you want how much? 15 million. So this question is how much US dollar will it have to sell? 1 upon 51.3625 into 15 million. So 15 million divided by 51.3625. It's $0.992942. Okay. So 9,92,942 rupees. Okay. Dollar, sorry. $0.99 million. Sorry.
It comes to
It will come out
2,92,022.
4 lakh something. 2,92,000. Right. By mistake, I had pressed, I'm sorry. Instead of 15, 51. So it comes out to be this comes out to be 0.29204185. So it comes out to be 2,92,042. Okay. right? That's what you're saying?
Yes.
All right. So I hope these 4 questions are clear to everyone. Do repeat all these 4, and we'll continue with the next assignment in the next questions onwards. We'll do it in the next class. Today, let's just talk about some MCQs. I would like you to attempt this. Tell me what are the right answers. If you have any doubts, please ask again. Anyone? Geeta, Sanjay, Prithviraj, Ankit, Manish, Leela, anyone? Ankit? We have 2 Ankit and Ankit. Anyone has any doubt?
Ma'am, can you repeat it? It's very confusing.
Okay, I'll repeat. The ABN AMRO Bank question?
Yes, ma'am.
Okay, thank you for asking. It is just, it requires a little practice. That's it. Okay. So 51.3625 oblique 51.3700 are the rates of rupee to $1, right? These are the quotation given. First thing.
Yes, ma'am.
Right. Second thing is requirement. What is the requirement? 15 million rupee.
Yes, ma'am.
Okay. So don't ignore the Vostro Nostro account as of now. Now ABN AMRO wants 15 million rupees against USD. Right?
Yes, ma'am.
So you want to buy
Dollars.
you want to buy. Why you want to buy? Because you have to fund your account with Canara Bank in New Delhi. So far clear?
Yes, ma'am.
Now, do we have a rate? 1 rupee is equivalent to how many dollars? Do we have a rate like that here?
No, ma'am. No, ma'am.
So we need to construct it.
Yes, ma'am.
We had rupee in the numerator, dollar in the denominator. Now we want dollar in the numerator, rupee in the denominator, exactly opposite.
Yes, ma'am. Inverse of it.
And how do we do the bid and ask opposite? 1 by ask oblique 1 by bid. Okay, agree?
Yes, ma'am. Here I am doing mistake. Yes, ma'am.
So 1 upon 51.3700. This will be a smaller number. When the denominator will be higher, then only the number will be smaller, right?
Yes, ma'am.
1 upon 51.3625. Now you have a direct rate of how many rupees you want to buy or sell. You have a quotation of rupee with respect to dollars now. 1 rupee is equivalent to how many dollars?
Yes, ma'am.
So if 1 rupee is equivalent to this many dollars, 15 million rupee will be equivalent to how many dollars? So that is how many dollars you'll have to pay if you want to buy rupee. Okay.
Yes, ma'am.
Now buying rupee, which rate will be applicable? You are buying rupee. So bid will be applicable or ask? When you
Ask.
when you want to buy things, you have to pay the higher price. Ask. So this rate will be applicable. Use this rate and multiply it by 15 million. Okay.
Yes, ma'am. Clear.
That is the number of US dollar ABN AMRO Bank will have to pay. Now, instead of going the long way, we could have just stick to this equation and quickly done our calculation. How? We want to buy rupee. Okay? We want to buy rupee.
Yes, ma'am.
Indirectly, buy rupee indirectly implies sell dollars. Agree?
Yes, ma'am.
Buying rupee is equivalent to selling dollars, opposite of the other currency. So you sell dollars. When you sell something, what rate is applicable?
Bid rate.
Bid. So if you had sold $1, you would have got 51.3625 is what you would have got if you had sold $1. 1 rupee is what you would have got if you have sold 1 upon $51.3625. And if you had sold 15 million rupee, this is what you would have got. Got it? So you can straight away divide by the bid rate if you are given when you are given a direct quote, in the sense if you wanted to buy or sell dollar, you would have multiplied by any of the two rates. But if you know that your requirement is the opposite, then you divide by the applicable rate. Okay? So 15 million divided by 51.3625. Is it clear, Geeta, now? Sorry, is
Yes,
what Geeta was asking, right? Okay. Leela, everything clear to you?
Yes, ma'am, clear.
Great. Right, so let's quickly do some of the MCQs here. Is this okay? Perfectly? So the first one, exchange rate between INR and USD is rupee 83 is equal to $1. Which type of quote is this? What is the right answer? We'll discuss.
Direct quote.
Direct quote for?
Direct quote.
Direct quote for?
India.
India. Complete answer is it is a direct quote in India. Great. Which of the following represents an indirect quote for someone in India?
C.
B.
B is the right answer. Very
B.
good. B. Third question. USD INR rate is 83. What does this mean?
A. $1 is equal to 83 rupees.
A.
Yeah. $1 is equivalent to rupee 83. A is the right answer. Good. All of you are getting so far, no? Not just the ones who are speaking. All of
Yes.
you? Right. Great.
Yes, ma'am.
Good. Now, bank quotes USD versus INR as 83.00 oblique or dash 83.10. Which one is the bid and which one is the ask?
B is the answer.
Bid is 83, ask is 83.10. So if you want to buy $1, you need to pay 83.10.
10.
And if you need to sell $1, you will get 83 only.
83.
Good. What is the difference between bid and ask called?
Spread.
Spread. Spread.
All right, calculate the cross currency quickly and let me know what the answer is.
.015.
How much?
D. 0.015. 015.
0.015.
Okay, what you're saying is 0.015. You are saying GBP INR. That means 1 INR will give you 0.015. Okay. Anyone else differs or all of you agree?
Ma'am, B 103.71.
Someone is saying D, someone is saying B 103. But you see, if you see B and C are not same. What's the difference between B and C? You got to B by using
Ma'am,
this.
one is multiplication and other one is multiply. And we get, ma'am, when we get divide now, USD will cancel and INR will be in denominator. But when we sorry ma'am, I think I am. Yeah, ma'am. When we multiply, we will get GBP INR. It's 103. When we will divide, it will get reverse. USD will get down and INR will get in numerator.
1 GBP is equal to INR how much? This is what it means. Okay, firstly, GBP hash INR. 1 GBP is equal to INR how much?
Ma'am, it will be 103.75.
Yes. This is the right answer, 103.75. 1 GBP, how much you will have to pay in INR? 103.75. So this is how it is written. 1 GBP is equivalent to USD 1.25. 1 USD is equal to INR 83. So if you will write it like this, it will be USD upon GBP. This is given as 1.25. INR upon USD. This is given as 83. And you need INR on GBP. So you can see that the two, if you multiply these two, that is what you need. You need INR in numerator, it is there. You need GBP in denominator, it is there. So simply multiply. Okay. Right. 1.25 into 83, 103.75 is the answer. Do we get this answer only, no, when we multiply? Okay. Right, team? I hope these questions are clear to you. 103.75. So thank you so much, all of you. We'll end our session here today and continue from where we left in the next session. Thank you, all of you.
Thank you, ma'am.
Thank you.
Thank you.
Thanks for the nice session and making it more interactive. Now, students, so far as the topic of foreign exchange risk management is concerned, now, student, please note that this topic is very important from the viewpoint is that now the world has become, we can say, world has become globalized. It is just like a village. If I talk about somewhere around 93, before industrial policy has come out, the exchange rate mechanism was totally different. There were used to be a fixed exchange rate for buying and selling, something like that. And it was only after post 1993 when the market dynamics of the exchange rate market has been changed. Earlier, this was used to be determined by the RBI and they were used to be fixed and all the transactions are used to take place at that rate. After post 1993, this rates has become market determined forces. Now here today, it becomes a market determined forces so much that even we see that someday, I think any month has been left where some news has come into the newspaper that dollar has become stronger or dollar has become weaker. Of course, for the last some time, it is becoming stronger and stronger. Now, please see the dynamics of this exchange rate mechanism. When they become the stronger, of course, the countries or companies which are in the export business, they have a huge extra profit margin because when they will get it converted into Indian rupees, of course, the amount will be on the higher side, whereas importer are on the loss side. Now, when we see that, if we see practically, now say for Infi or Infosys, they are in the profit. TCS, these companies that are providing consultancy to outside India, they are in the profit. But whereas on the other side of it is the Indian oil. Okay, Bharat Petroleum, the companies which are importing oil, their balance sheet or their profit and loss account suffer due to higher payment. Now they have to make or the outflow is the higher side on the Indian rupees. So this is the dynamics of the stock exchange rate market. Now, since this syllabus is from the viewpoint of the company, of course, first in today's class we have understood what is the dynamics of the exchange rate, for spot rate and forward rate, and what is the spread, all that. Now, as we will move further, we will go into the nitty-gritties of the more exchange techniques, or we can say hedging techniques, because the main
you can say main objective of this topic, or the learning objective of the topic, is to hedging of the foreign exchange risk. So thank you very much, Anjali madam, for sparing your precious time. And Anjali madam, if you can just share the writing pad on the screen, because I want to share my telephone number as well as email ID. Just one.
Yes, sir, sure.
Okay, just write it down. I am just
Sure.
okay, student, you can contact us as at this number 0120. I'm just write only the number, only 0120 dash 3045 956. This is my contact number. Okay, even you can send us the email. Madam, just write down SFM dash final
Dash
final @ICAI.in. That's it, man. Thank you. So, student, thank you very much for sparing your precious time and keep the session very engaged. And thank you, Anjali madam, for sparing your precious time and letting the student also. Thank you.
Thank you.
on
Thank
this
you
one.
so much.
Thank you.
Thank you, everyone.
Thank
Bye.
you, ma'am.
Oh, thank you, ma'am.
Thank you. Bye.
Bye.
Thank you, ma'am.
Thank you. I can drop from the call, right?
Madam, you can log out, no problem. Basic, yeah, it's over now.